When I first got into the life insurance industry, within my first 2 to 3 years, I remember one day working with my sales manager at the time. We were putting together a plan for a potential client at the firm, and I'm looking at the cash value. And I'm playing around with different products and illustrations and saying, hey, how come we don't design policies in this manner, which really beef up the cash value? And the response I got was, you can't do that. And when I continued to question my superiors more, the response I would get would be, well, when you look at the long-term performance of a life insurance policy, it's about the same. Whether you take more money up front or you take less money up front, long-term, if we look at the client's age of 80 or 85 when they're about to die, the cash value and death benefit are about the same on the illustration. And why that was stated was because if the client has less money in cash value up front, that resulted in more commission for the agency, the sales manager, and me, if I was on the case. And a lot of times when that response is used, the typical follow-up from the other agent, if it's me in this example, would be okay, sounds good if all things are equal at the end of the day and I can make more money with option B, let's go with option B. The thing is, there was an unseen element when it comes to actual policy performance, and this is what causes so much buyer's remorse when it comes to whole life insurance sales, where someone is deliberately taking out a life insurance policy and they're interested in the cash value benefit. I want to maximize the cash value. I see one thing on an illustration, but then reality is different, much, much different. And how do I actually see that reality beforehand? Before I put my money into a product is what I mean when I say that. And to get that information, you really have to dig deep as an agent. Clients and policyholders don't know the questions to ask. Many agents don't know the questions to ask in order to get that information. We're going to hit on some of that information and bring it up as we progress through this video series. But what we're mainly going to hit on is how do I get the most out of my policy? We're going to look at different designs when it comes to cash value life insurance products. What we'll begin with here is as follows. What I just hit on, a sales tactic that I was exposed to, I don't want to use the word encouraged to use, but it was discussed in the agency to say, hey, long term, the clients are going to have the same amount of money. So we sell these types of products because it drives more premium, more revenue, more commission for us. We can be the top dogs when we're compared to other agencies out there. That's just, call it the culture of the industry, just from being on that side of the business. Now, a lot of agents dislike us. Not all of us. I know a lot of you guys are my friends watching this. But the sales tactic that has been used in the industry frequently is less money upfront, particularly in a cash value life insurance policy, can result in more money long term. Particularly, we'll hear this if dividends go up. If you take less upfront, you definitely should have more long term. The thing is, I'm always big on paying attention to words, choice of words, is I'll hear the word should have more long term. I can't recall when I've ever heard you will have more long term. Any experienced agent knows not to say that, because when you look at, again, history, not illustrations, but history and real policies that have lived the test of time, when I take an illustration that produces more long-term, but then in reality it does not produce more long-term, it under-delivers. If I state as an agent, you will have more long-term, and then I do not have more long-term, or you don't as the client, what's going to happen there? Yeah, you're going to come back and say, you said I will have more money long-term, Steve, but I don't. What's going on here? And now there's a potential problem there. So, going back to the choice of words, you should have more money if you take less upfront. That's often used because you should, if things go according to plan, with respect to how dividends are applied on whole life insurance policies. A little complex. I'm going to use some visuals throughout this video series. So, to summarize that, less cash value, so when I say less money, less cash value for you, the policyholder, upfront should produce more money long-term based on an illustration. And that is amplified if dividends go up. Here's the thing that's often not stated here, is less money up front, particularly cash value for you, results in more commission to the agent and agency. So the reason why really has to do with policy design. Before we hit on the policy design though, the why. Why are people attracted to cash value life insurance in the first place? Because there's a lot of negativity out there about it. There's also a lot of positivity. When I look at big corporations, wealthy individuals, they have used whole life insurance, different types of cash value life insurance in addition to whole life for a long period of time. But then I've got an ugly side of it as well. So if it's going to be good or not so good, if it's going to be good looking or ugly, has to do with the policy design. But here's the core benefits, particularly around the cash value. Safe, liquid, and tax-free. So when I say safe, to be more specific here, the net growth rate, internal rate of return is what I will refer to this as, is often going to fall between 3 to 5%. And that's the net growth rate, not the dividend rate. If you see a dividend rate of 6% with an insurance company, your net internal rate of return, your actual growth rate over time, may be between 4 to 4.5% after we back out the actual cost of the life insurance. But what do we see here? Net internal rate of return, somewhere between 3 to 5%. The question frequently comes up, what am I earning on my cash value? What did my cash value grow by last year? What was the actual return on my cash value last year? These are questions people have. So rather than play a word game and say, well, the dividend rate was 6%, but my money didn't grow by 6%, just be straight up. Like it grew by 3%. If I had $100,000 and I see $3,000 of net growth, that's 3%. That's what it grew by this year. Liquid, I can access at any time, and I've got that unique loan feature. A lot of you know what this means. If you don't know what that means, a unique feature to a cash value life insurance policy is if I decide to borrow against it, my entire cash value, any money still in cash value, think of it as equity, and what I have loaned against it continues to compound for me as if I never touched it in the first place. So I get that constant compounding over time, and I can access it any time. A lot of people take advantage of that for opportunities, and then tax-free if I do things properly. Like I don't trigger a MEC, I don't cash it out with a gain. I want to avoid taxable events, which we've got other content on that. So let's address this piece. Less money up front can potentially result in more money long term. So when I look at policy design here, one of my favorite topics, when you pay money into a life insurance policy, you, the policyholder, can actually decide where that money goes. Dollars can be allocated toward the insurance premium. Premium dollars, with respect to your cash value, what happens here? If it's a traditional policy, you'll see this on an illustration called a paid up at 121 or life 100 or life 99. Those represent the ages you can pay into a policy. With a traditional policy like that, I'll see zero in cash value often the first 2 years. Some products, it's only the first year. Some products, like a limited pay product, a 10 pay is a great example, will often credit approximately 30 to 35% on average of the base premium to cash value up front. And then you've got high early cash value products, which give you approximately 80 to 90%, sometimes a little bit more, depending on the company and product. But that's on the base premium dollars. Generally speaking, though, if I were to take the most commonly sold whole life insurance product, what most people own, the first and second year, I won't see anything show up in cash value. The reason why, from the insurance company's perspective, is that they are going to overcharge the policyholder for the cost of insurance, for the actual life insurance policy up front. Now, as you continue to make premium dollars, you will see money show up in cash value. That's money you'll have access to, begins to earn dividends, you see it compound, it gets better and better as time passes. Why people are not attracted to whole life insurance, though, is often due to the early years, when I've got next to nothing or I take a negative hit on my money. It takes a long time just to break even. What I mean when I say break even is get your money back. So premium dollars don't build cash value, not initially, eventually they do. Versus this guy, PUA, which stands for Paid Up Additions Rider. I like to refer to this as a cash dump-in. Money I pay here, guess why I call it a cash dump-in, shows up in cash value. Right off the bat, you're going to see more than that. You'll see between 90 to 95% of whatever that PUA payment is show up in cash value immediately. So you don't get 100% of that, and the reason why is because there are fees that are associated with that. However, the majority of those payments show up in cash value. That's money I can access anytime. That begins to receive dividends and the guaranteed rate. This is really the key to accelerating the cash value growth on a life insurance policy, both on the guaranteed and non-guaranteed basis. It will buy you some death benefit. It's very small relative to premium dollars. Depending on your age and your health rating and your gender, on average, if I paid in $1,000 here toward this PUA rider, I might see another $2,000 to $3,000 show up an additional life insurance benefit. So with this, if you're looking at a cash value life insurance policy and you make the statement or your goal is to maximize cash value, I want as much cash value as I can possibly get. I don't really care about the death benefit, not right now at least, or I've got other life insurance in force. How do I really beef up this cash value? That's why I'm putting money into this product. Otherwise, I wouldn't be considering it. Where would you want to put your money? My father asked the question when I was early on in my career many years ago, can I just put 0% here and everything else into this area? And the answer was, no, you can't do that, Dad, unfortunately. Now I like to go into a lot more detail, so rather than just say no, we'll go into some detail here. There are different, or I should say there are limitations that are set by insurance companies which limit how much money we can pay toward both of these areas. So limits are the key. I've got insurance company limits, then I've also got IRS limits. That has to do with the MEC limit. But when we look at policy design, we often talk about splits, right? We have videos on our channel. If you just search split study, you'll see them pop up. But let's take a look here. When we look at a split, what this refers to is where is my money going? So we've got this term over here, this 1090 split. What does that mean? Well, this represents, if I'm paying in, let's call it $100,000 per year into a life insurance policy. If I've got a 1090 split, that means that 10% of the total payment, which would be $10,000, is allocated toward the premium, and then the other 90% is allocated toward the PUA rider. So what I'm doing is reducing the insurance premium as much as I can in order to be able to get everything else of my payment toward PUAs to really maximize that cash value growth right out of the gates. This way I see the majority of what I pay into the policy immediately available to me, begins compounding. I see an early break-even point, strongest guaranteed values, looks great. 1090 split, if I were to look at some of the major mutual companies, like a Mass Mutual, Guardian, New York Life, often as low as I can go with that base premium is 10%. Now some companies, if you look at our All About Guardian videos, you'll notice in the first year, they allow us to go much higher than that. You can pay 50 times the base premium. Some companies, smaller carriers, don't have a multiplier. Smaller companies like a Lafayette Life, for instance, will allow one to pay a maximum of $500,000 per year into PUAs, regardless of what the base premium is. So all companies do have different limitations there. But if you want to maximize the cash value, what do we want to do? Drive the premium down, beef the PUA rider up. And you can also make this very flexible. If I want this 100K number, what a lot of people will do is set up a policy where they will commit to $10,000 per year, and then at their discretion, they'll add additional funds up to $90K per year, making the policy very flexible. Pretty nice, right? So here's where I'm going with this. So I've got that 1090 split, but then I also see a 50-50 split and also a 100% base premium. Here's the thing. What do those different splits or different ways that I can design a policy, how do they impact your cash value? Again, if your goal is to maximize cash value, I'm going to pay money into a policy. How do these different splits directly impact you based on the seen, meaning the actual illustrations, but then also the unseen? Maybe it's guaranteed values, and I wasn't shown that. That's also on an illustration. Perhaps it's having insight on historical performance and how corporations actually structure these policies to beef up the cash value. Real data, not just projections. The design will have every single time a direct impact on your cash value and also a direct impact on the agent's compensation. So I always like to just have full transparency. So in this video series, we're going to look at how it impacts cash value. We're also going to take a look at how it impacts commission. Keeping all things equal, same company, same product, same design. We're going to have a lot of fun as we go through this. But again, if your goal is to really maximize the cash value of a life insurance policy, this will provide you with a lot of additional insights. You can ask your agent the right questions, make sure that everything's properly set up. Hopefully you find this informative. So we are going to cover quite a bit in the next several videos. I hope this video did help. If you have any questions, please feel free to leave them in the comments below. You can email us or call us directly. Please hit the like button and subscribe button if you haven't already. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.